You heard me?
Got it.
What's up, everybody? This is another episode of Dispense Written on Pill Talk Podcast and Network. You know what it is. It's Dispense Written. It's the third Wednesday of the month, and we're live. I got my good co-host here, Terry Scipio from Scipio Financial. We're here to deliver you some more good information. Yes, sir. On the stocks. We're going to talk a little bit about what we talked about the two previous episodes, which was the history of the stock market, how to invest in the stock market. And then we're going to jump into this time, talk a little bit about inflation, a little bit about taxes, some of the things that can kill your gains with the stock market. But before I go any further, let me make sure everyone introduce my my co-host for this segment, Terry Scipio. How you doing today?
Man, I'm doing great, bro. Doing great as always, man. I find myself getting giddy on these first and third Wednesdays, man, when it comes to doing Dispense Written. So again, ready for the people, man, ready to give some good advice. Well, not good advice, but some good knowledge, good content to the people this evening.
Great. Man.
So how was your week so far, man?
This is an interesting week, to tell you the truth. Interesting week. Well, a quick story for today. I'm on the phone with one of my friends and we were just talking about business and investments, because I guess at this point, this is kind of where all my conversations are going towards anyway. He know I do other things on the side. He was talking about one of my businesses, and I was telling him, like, yo, don't run into my business like you're in the housing market, like you're buying and flipping houses. Stay into that. And let me be the guy that does X, Y, and Z on this side. And then once you get your money saved up or stacked up, I can show you and teach you everything so you can go from 0 to 100 instantly and vice versa. He was like, man, I ain't worried about that. I got my money stacked up. You know, curiosity killed the cat. I was like, so what are you saying? Like, how much money do you have stacked? He was like, yo, I got 6 figures right now in cash, just chilling in the bank. And I'm like, I talk about stocks on Dispense Written Wednesdays on the first and third Wednesdays with my co-host Terry Scipio, just in case you just needed to know. He was like, yeah. He was like, but man, I ain't messing with the stock market though. I'm like, you're not messing with the stock market. I'm like, that's the easiest way to make money, hands down. He was like, yeah, man, because I don't want the frustration of having to deal with these contractors, these employees, and all this other stuff. I'm like, yo, when you in the stock market, those people, the money are those people, the money are your contractors, the money are your employees. They're going to work for you endlessly.
That's a good point.
He was like, man, I'm fishy about that stock market. I said, all right, you say you got 6 figures, right? Let's just go hypothetically 200,000. I'm like, if you take 125,000, right, that you're not using immediately, put it in the stock market in the S&P 500, give yourself about a year, that 125, I'm not no financial expert, but I just say the 125, if the market keeps moving in the way it's moving, I guarantee that you probably get it at minimum $25,000 to $50,000 that you didn't have to work for, that you didn't have to put no sweat equity in. He was like, but what if it crashed? I'm like, man, I know people who was in the stock market when the pandemic happened, even me, and they went down 5 figures, 6 figures. They held their position because they didn't lose the stock money. They didn't lose the quantity of stocks. They just lost the value.
The perceived.
And then when the money went back up, when the percentage of the stocks went back up, the price of the stocks went back up, they were up 40%, 50%. Some people say some of these personal stocks, like an individual stock, was up like 100%. I'm like, yo, you just got to wait it out. And I don't know. I think he need to tune in to Dispense Written on the first and third Wednesdays. Listen to me and you about what's going on with the stock market, because clearly I didn't do a good job, because he left the conversation like, nah, I'm not with that. I was like, all right.
It's people can be, it's great to be apprehensive, but that's why you need to get some education. That's why it's good to to consult with a professional, so they can ease some of that apprehension and help them understand the ins and outs of the stock market. And one thing that the one word that we shy away from using when it comes to the market is guarantees. So you just want to say there's an opportunity for certain returns or whatever, but you don't necessarily want to guarantee anybody anything. You want to more so under promise, over deliver type of thing.
Man, we probably have to be like lawyers, be like, yo, it's a possibility and plausibility.
There you go, man. There you go. But that kind of brings me to my agenda that I want to share with the audience tonight. And I know you kind of hinted at it earlier, but I'm gonna go ahead and share my screen. Transition that over to me, bro.
I got you. Give me 1 second.
But tonight is going to be pretty interesting, in my opinion. I think I'm sure we had some questions over the last couple of weeks about what are some things to look forward to, or some characteristics to look for when someone is considering investing their hard-earned money. And those are going to be some of the talking points we talk about tonight.
Hold on, before we get too deep into it, let me make a quick announcement right now.
Go ahead.
So, Pill Talk Podcast is a premier podcast that is tailored to medical professionals, entrepreneurs, and people looking to invest in finances. I sit down and talk with different individuals about their jobs, and we cover in our conversation their career path, the education level to reach their success, and how they're impacting their patient lives, most importantly. And we are also looking for sponsorships at Pill Talk Podcast right now. With the sponsorship, you'll get a positive media attention with the association of being with Pill Talk Podcast, and your commercial or business will be mentioned with the broadcast, and over thousands of people will be reached and hundreds of engagements daily. So our marketing listeners are roughly 74% women, about 23% men, ranging from the age of 28 to 34. So if you're looking to get some network or get some attention to you or your business, you can sponsor Pill Talk Podcast, and you can also sponsor Dispense as Written. So just wanted to get that out there, just in case anybody wanted to get their business a little more known, get some traction to their company. But back to the scheduling program.
And you got some good viewership there, man. From
Appreciate
ages 28 to 30, 34, 70% females.
So I know if anybody got a beauty product that they're trying to get out there, yo, this is the spot.
This is the platform to be on, right?
Yeah, you already know.
Definitely. Well, let me share my screen, man, and I'm gonna read a quick disclosure for this evening as well, just so that we cover all our bases. But this is going to be part of what we talk about tonight. But this podcast is for informational purposes only, and I'm a registered investment advisor and broker with Park Avenue Securities, and Pill Talk is not affiliated with Park Avenue Securities or Guardian. And like I said, this is for informational purposes only, and everybody should carefully do their own research when it comes to investments or investment ideas. So just wanted to put that out there. And so now, without further ado, let's get into what we came to discuss tonight. I'm Terry Scipio with Scipio Financial. As you can see here on the new printed shirts, QR code on the back. Maybe I'll show y'all what that looks like on one of the next episodes when I got a spare one that I can hold up for the camera. You know what I mean?
The merch coming soon. It's gonna be out soon.
Oh yeah, man! I'm gonna start sending them out to clients here. So let's just recap real quick about the previous 2 episodes that we've done thus far. And I got to say, man, we've gotten some great viewership as we were talking just before the podcast this evening. Got some great viewership of our previous 2. I think we're up to almost 100 views on our very first one, and up to about, I think, 25 views on our second episode that we did. So we appreciate you guys coming out to view the content. Please leave us some comments or some questions down below about, some things that you would like us to cover on these first and third Wednesdays as we talk about stocks and anything dealing with personal finance. So in our previous 2 podcasts, the first one, what we did was we took a look at a history lesson and looked at the S&P, the history of the S&P 500. And in particular, we looked at a monthly chart that's looked very similar to this. And we talked about, one, how to interpret what these patterns look like here on the S&P 500. And if you can see here, the pattern here on the S&P 500 is about every month or so, about every 17 to 20 days or so, the S&P 500 retraces and comes back to this level of what we call a exponential or simple moving average here. And it touches this 50-day moving average here. We can see it happen here, here, and so on, so on, so on. And here recently, it did the same thing. Now, tomorrow, we'll see if we can continue on this green streak, because recently here, over the last week or so, we've been under some duress, but this is typical of the trend here. And as we talked about in our first podcast, we talked about trends within the stock market and within an index. And we can see this is a very strong, what we would call uptrend here in the stock market. So although people, get weary when they see the market kind of roll over like it did right here, it was at a previous high up here and then rolled over. But you can see the trend stayed intact, because from a technical standpoint, it came right back down here to the 50-day moving average like it has done on previous occasions. And we can see here, after about, a few days of this selling pressure, then we get what we call a bounce to the positive side. So that's what we looked at in our first episode. We talked a little bit about technical analysis. We talked a little bit about what the history of the stock market looks like. And what we determined was that if you stay patient and you hold your position, despite what's going on, in the mass media and how the mass media sometimes portrays and says that the sky is falling, taking money out of the stock market is actually, if you did the more contrarian thing and actually did the opposite of what everybody else is saying in the mass media, you would have came out very handsomely by investing and just maintaining your position in the S&P 500 ETF, or just outright buying the S&P 500 index. So that was history lesson number 1. Episode number 1. If we go back and just talk about what we talked about a couple of weeks ago when we discussed the stock market basics, we basically talked about what is an ETF, what is an index, and we came out here to our good friend, our good website, Investopedia, which is pretty much Encyclopedia Britannica for those of us who remember those big, thick encyclopedias that was probably at your grandma's house. And actually, people used to come around and sell those things, which was pretty funny. But now we got everything online, right? Everything is digital. And you can come right out here to Investopedia, which is one of the sites that I recommend, to my clients when they're asking me questions about, what would be a good resource to tap into. Investopedia is always one of the resources that I always recommend outside of some great books that I've read over the years. But you can come out here and you can see and see what the definition of an ETF or an exchange traded fund is, and just get familiar with some of the basic lingo of the stock market. You can come out here and search just about anything you want here on Investopedia, and you can get at least a sound understanding about what it is that you may have heard on CNBC, or better yet, heard on Dispense's written podcast here every first and third Wednesday. So we talked about what is an ETF, what is an index. We talked about how you have different sectors that you can invest in if you're talking about purchasing ETFs. And we talked about how ETFs will simplify your trading if you said that you're someone who wants to invest in a particular sector, like the technology sector or the healthcare sector. You can purchase an ETF that will help you simplify just trying to bet on one particular company, and have that, pretty much placing all your marbles in one basket, rather than buying a complete list of companies that's in that same sector, and you can benefit from all of them moving in a positive direction whenever that happens for that particular sector or that particular index. And then we talked about how to choose an ETF, and I took people out here to the Sector Spider website, where, if I can get my technology to work properly, I can show y'all how to go to the website. Here we go. All right.
And look at that. They have Black doctors up on the Google page today. I just want to just drop that out there. You know what I mean? Only on Dispenses Written, yo. We showing y'all that.
It's perfect timing, right?
Yes, sir.
And so these are the different sectors that make up the S&P 500. Got about 11 different sectors. Here on the Sector Spiders, they have it broken down in about 13 different sectors. But these are the ETFs that you can purchase that will be companies that are made up within the S&P 500. So you have, the utilities, you have the technology sector, you have the consumer discretionary sector, you got the healthcare, you got the financials, all of those. So the Sector Spider, this is just one of many different ways that you can come out here and buy an ETF.
Let me just say my little quick input, since we right here on the Sector Spider, my bad. So if you can click technology real quick.
Okay.
Just want to let someone know that if you're looking to get into the stock market and you've gotten to this point where you're in the S&P 500, or you decided you want to be in a particular sector and you're just seeing that sector is doing well or whatever. One way, if you want to know, I think we're going to cover this tonight, but we talked about this last time. You don't know, like, yo, I want to know how I can get into individual stocks, right? So we taught you how to get into the S&P 500 in general. We taught you how to get into the sectors in general. So once you get into a sector like technology, and you're like, listen, I want to know which one is the best stocks to get into, you can sit here, click the sector, you can come down, and it'll tell you the holdings and the weights. And right. You can look at the weight of what a professional is doing and putting into a company for that sector. And you can be like, you know what? Let me mimic this in my own portfolio, so that way you can have an upside to people who don't know this knowledge at this level, right? So as you can see in technology, two companies mainly almost hold 50% of that sector. So if you wanted to start investing and you already got established within the S&P 500 and already making money with that, and then now you want to get into an individual stock, this was a quick way to show you one of the top stocks that you could get into.
Right. And just said a different way, you can come out here and drill down on the portfolio of a particular ETF and just look at the holdings and the weights of the stocks that make up the ETF. And then you can make an informed decision, or at least start the process. Because again, we always want, our listeners to do their own research. And then you can start the process and say, okay, well, if the XLK ETF has Apple and Microsoft as two of the top holdings within this ETF, what are some of the fundamental characteristics that would make this appealing for a portfolio manager or whoever is the creator of this ETF to say, hey, Apple and Microsoft are such strong companies that I want those two companies to make up 40% of the weight of this particular ETF. And when I say the weight of an ETF, what you're looking at is how much influence, so to say this a different way, how much influence does these two stocks have on the outcome of this XLK ETF? So better said a different way, 42% or 43% of the time, or 43% of the outcomes that's associated with the XLK is largely dependent upon the performance of Apple and Microsoft. And so to bring us up to tonight's points that we want to discuss, which is what are the fundamental aspects of evaluating a company to potentially invest in, you want to look at what we call the CANSLIM methodology. And that's a methodology that I ran across back in 2015, I believe, or so, when I really dove deeper into stock market research and how to determine and how to educate myself so I could be a better professional for my clients, how to better prepare myself to know what's one of the methodologies that can be used to evaluate individual stocks. And so that's what we're going to take a look at tonight. And outside of this CANSLIM methodology, what we're going to also look at is how to evaluate the chart after you've done this level of research to say, okay, well, is this stock in an uptrend? Is it in a downtrend? Does the stock chart look healthy for me to invest in? And does it coincide with the fundamental research that I've done? Because there's two aspects of evaluating a company. You got the fundamental research, which will talk about the company earnings, the annual revenue, whether or not they have any new innovative products. Is there a scarce supply of the stock, but yet a strong appetite for it? Is it in a leading sector, but maybe it's lagging, so there's more opportunity for upside in that particular stock? And is there institutional buy-in, meaning have the big mutual funds, have the big ETFs, have the insurance companies, the companies, the entities that have the power to move large volume of stock by their influence and deep pockets that they have to buy a particular stock, are they playing the game as well? And last but not least, the market direction. Is the overall direction of the S&P or the overall direction of that particular stock, is it in an uptrend or is it in a downtrend? So that's the fundamental piece, right? So that's when you're kind of looking at the numbers, the financials of the companies. Does all that stuff look good? And then on the other side, you also have what you call technical analysis. And technical analysis is where you're looking at the price action on the S&P or a given stock, and you're saying, okay, is the price action looking healthy? Meaning, is it going up? Or is the price action looking a little wonky and it's in a downtrend, let's say? And so those are the two schools of thought when it comes to evaluating a stock. You got technical analysis and fundamental analysis, and those two together should help you gauge whether or not that's a great company to invest some of your money in. So let's get into it. Again, I'm gonna go out here to my good friend, Investopedia, right? Remember, like I said, you can find just about anything financially related that you want to talk about or that you want to know more about right here on Investopedia. And again, there's other sites that you can use. I just happen to like Investopedia because Investopedia, has always done me right when I come to look for something.
Listen, I'm gonna have to send Investopedia an email and tell them that y'all need to sponsor us on this.
They need to send us a check, right?
Yeah, like yo, we got thousands and hundreds of people listening every time to Pill Talk Podcast to getting this information on Dispenses Written and Pill Talk Podcast in general. So,
well, and I can't take credit for this methodology. It was started by this author here. I'm not going to mention the name, but y'all can read it here if you're listening to the podcast. But has a great book. You go check it out if you look up his name. But understanding the system. So what's the CANSLIM system? This is just an acronym that, like we see all over today, there's an acronym for just about everything, but CANSLIM. So here's what it all stands for. So number one, the C in CANSLIM stands for quarterly earnings per share. So earnings per share is a metric that you can look at and say, okay, based on what the company, so is the company, if the company is earning, say, 10 cents per share, in relation to quarter over quarter, is that figure increasing or decreasing? If a company misses its earnings report, that's not a good sign. That means something happened from a numbers perspective or from a fundamentals perspective that inhibited the company from meeting their quarterly expectations. And that could be a myriad of things. Like, for instance, when COVID happened, a lot of companies scrapped their guidance, and guidance is what does the future look like? So they're saying, hey, based on future projected earnings, we believe our guidance to be X for the year. If a company is repeatedly missing their earnings, that's not a healthy sign of growth for the company. Therefore, their stock price will probably suffer in the coming months or the coming quarters as they continue to miss those quarterly earnings reports. Now, on the A in CANSLIM stands for annual earnings. You want to look for companies that have a track record of growth, of consistency. So when you're looking at annual earnings, you want to look for just consistency. Is this company consistently trending in the right direction? Typically over a 5-year period. And the factor that you want to, base it on is ideally 20% year over year growth. If it's better, the more the better. Right? Now, the N stands for, is there any type of new innovation? Now, when we think about innovation and new products constantly coming to the market, what's one company that you can think of, Bartu?
oh, Apple. They just dropped the phone. They got the wearable products. When I say wearable, that's like the AirPods,
The watch.
the watch, man. And then they just announced that they're about to come out with their own car.
Yeah.
Like they're gonna be making their own car. So I'm gonna have to pull up in the Apple in a couple of years on y'all.
Definitely, man. So Apple is a prime example of new innovation. I mean, they are the innovation leaders. Another company you can think of is Tesla. Tesla is leading the way when it comes to this whole push for EV. If it wasn't for Tesla and Elon Musk and what he's done as it relates to EV advancement in technology and what they're able to do with EV cars, the auto industry wouldn't be going under this revamp, what we're seeing now, where a lot of these manufacturers are moving more towards the EV model and getting away from fossil fuel engines. But new products, do they have any type of new management coming into play that has a track record of success that will change the trajectory of the company? Number 4, or the S, stands for scarce supply. Now, when I say scarce supply, you always think about supply and demand when it comes to a stock. So if a stock has, say, most companies have already an allotted amount of shares out there, right? But so if the appetite for the stock increases and there's already a limited supply, what do you think that does to the price of the stock? If something is real scarce, if a resource is real scarce and everybody wants it, what does that do to to the price or to the value of that particular resource or stock in this example.
You know, the price going up. Price got to go up.
Right. So you want to look for companies that fit these characteristics where the supply may not, the supply is very tight, but yet there's a strong demand. Again, there's no better example than that, than Apple. Now, Laggard. Now, typically when you hear the word lag or laggard, you think of something not being relatively good, right? But like I said before, if you're looking for a stock that's in a booming sector, and maybe that sector, the particular stock that you're looking at just hadn't caught fire the same way that one of its other peers in the same sector have caught. And maybe you want to jump onto that, right? And you also want to evaluate, what you call the relative strength indicator. This is what you call a momentum indicator. And this is what we're looking at here. This is on Yahoo Finance. This is an indicator that you can add. Here you can just go to indicators and just pick RSI indicator, and it'll add it to your charts down here. We're not going to get into a whole lesson on technical analysis. We can do a whole segment, 3-part series on technical analysis. But this is one aspect of technical analysis where you use momentum indicators to help give you an indication about where a particular stock could potentially go. And the RSI says, up here at around 70, if you at a reading of 75, 70 to 80, that's what you would consider an overbought scenario, meaning it's been too many people buying. And what you typically see is where it reached up here. If we mirror this onto the stock chart bar too, as the RSI got up here to around 80 on Apple,
both hit a high and then both dropped down.
Right. So as a stock becomes what you call overbought, and the RSI indicator indicates at a level of 70 or 80 or above, then that's when you can say that a stock is what I would say is white hot, meaning it's ran extremely too long and it's probably due for a pullback. And that's exactly what we see happen here. And again, no indicator is 100%. There's always going to be something faulty in the stock market because nothing ever goes 100% according to plan. But what you can see here is, this thing is almost spot on right here. It happened again back here in January of this year. It ran hot, ran up here to about 71, a reading of 71. And then you can see here on the chart, we got a little bit of a pullback. Well, same thing here. Ran up at about 69.70, got a pullback, just like we saw here. So again, the RSI, or the relative strength indicator, is just one momentum indicator that you can use to help you figure out or get an idea about whether or not a stock is overbought or oversold. Oversold meaning the exact opposite, meaning, a lot of people have sold the stock. It was down here at a low. What you typically see is it starts to climb after a while. See, it comes down here to a low, and it starts to come back up.
I got a question for you.
Go ahead.
So when an RSI, when is a good time to try to buy? Like you said, it's hot at a 70, 80. Mm-hmm. When is it like, you're like, okay, it's at like a 30. Right now is a good time to get in. Like, what number would you say is a bottom for RSI to signal someone to be like, it might be time for me to buy a few shares in this stock?
So you can see here, this defaults to about 20 and 80. You can trim this to whatever you like. So some people may set their RSI, the low, to be 30, right? And they say, hey, I don't care what's happening. If the RSI gets down here to 30, I'm buying, because I know this is Apple. They're a strong company, strong track record, always innovating, right? Mm-hmm. More than likely going to beat revenue expectations. And they're going to be consistent with their annual earnings year over year. For the most part, if it's Apple and Apple is down here at down here at 30 on the RSI, I'm buying, right? And typically what you'll see is when it got down here to this point, it does at some point, it rights itself and finds its way back up. And you see it comes back down, then rights itself back up here. So this is just the cyclical nature of stocks. But long term, what you see is you go back here, stocks typically are going to trend higher over time. But a lot of people freak out when they get the 10% correction or 20% correction in the stock market. That's not a time to be running scared. That's a time to be gobbling up shares. So let's talk about the I. This is really important. So institutional sponsorship, or better yet, just institutional buying. Is there large hedge funds that are participating in buying stock? Is it large insurance companies that are buying the stock? If so, if the appetite is heavy, because despite what most people think, it's not the retail investor that actually moves the price of the stock for the most part. It's typically big institutions that have much deeper pockets than we do as institutional investors. And that's when you see huge price jumps in the stock market when the volume, you see these bars right here down here at the bottom.
Yeah.
Those are volume indicators to tell you how much volume came into the stock on that particular day. And when you look here, a green bar is a good thing. So that means the price was being pushed up. A big red candle means that the price has been pushed down that day. So when you see a big green bar, then we know that there was some deeper pockets coming into play on that particular day. Let me find a big green candle that we can reference so I can show you what I'm talking about when we look at the chart here. Where was it? Here's a nice one. Look how big this candle is on this particular day. That's just showing you that. Well, I need to lower this so I can get more space to operate my screen here. All right, so we see this big green candle right here. That's just showing that there's a lot of people buying that day. So you see a big candle on this particular day. And vice versa, you see a big red candle here, right? Big red volume bar. That means a lot of people were selling that day or selling off their shares. That makes sense?
Yeah, I got you.
And so that's those are probably large institutions that are doing a lot of that buying and selling on those big days, whether it be a big up day or a big down day. Last but not least, and this is where we'll go dive into more of the charts here on TradingView, but market direction. So let me just ask you a quick question, Bartu. So if we can see that this is a uptrend right here, and we can see that as the index or as the S&P approaches this top line here, what typically happens as it approaches this top line? What typically happens?
Hold on. What line are you talking about? That one?
Yeah. I mean, we could draw this a couple different ways, but
I think you're trying to say like they start reaching resistance. So they reach a point and it's resistance pushing it back down to get the price back to level off where the market feels it need to be leveled off at. And then it hits the bottom and then it I won't say resistance, then it pushes itself back up to get to where it needs to be again.
That's right. So what we can see here is every time it approaches this, top line, what we call resistance, then we see the stock take what we call a breather, right? So it's not like it's a 20% correction and it's falling off a cliff. No, it had a nice run. It ran up here, and now it's coming back to take a little breather. It ran up. Now it's coming back to take a breather. Ran up, take a breather. Ran up, taking a breather.
That's like some exercises right there. You got to take a little break after run up the stairs.
Right. After you've had, let's just measure this out so people can get a good understanding of what I'm saying here of how to run up. So it comes down here to this general area of what we call support here, right? And what we're going to do is we're just going to measure up here to where it started to kind of roll over. So after a 5.4% move, call it a 5.5% move from here, from this low right here to this high, the stock market says, whew, man, I'm out of breath. You know, we had this nice run up. I think I need to take a breath. And then you see that it comes back, collects itself back to the same general area that it came to before. And then it says, okay, I'm ready for another move up. And boom, that's exactly what happens. Takes a break, runs up. Now it's taking a break. Now, based on the previous trend, what would you typically anticipate could possibly be the next move? Because nothing is 100% in the stock market. But if you're a betting man and everything stays kosher, where would you think the next move might be?
Oh man, you already know. It took its breath. We about to charge up. We about to go up.
It's a possibility that we could be on to new highs somewhere up in this range right here of about 4,600 on the S&P 500. So, you know, that's just my opinion and where I believe the S&P 500 could be headed in the next couple months. But if some bad news happens, we talk about going to war or raising taxes too ridiculously, then that could have an effect on the stock market and that could tank it, you know, 10, 20% or so in the near term. But long term, I think we move higher.
Yeah.
Makes sense?
Definitely.
So I hope that gives people some a good idea about how to do some fundamental research to look into a company, but also when you look at, you know, the technicals of a company and you just, you know, looking at the price action and you're trying to say, okay, where could this stock be going? Let's just go to Apple right quick, and then we'll go to the silent assassins of inflation and taxes and what that looks like on and how devastating it can be, you know, to your returns on your portfolio. So if we're looking at Apple here, you see this nice, what I call a flag pattern from a technical analysis standpoint. This is called a flag pattern. You can see like the flagpole here, then think about visually conceptualize a flag, this being a flag, and then, you know, this is typically a bullish pattern. It breaks out of this flag pattern, moves on up. Now from here, let's just measure this out and see. So if you have purchased Apple down here at 123, and it came all the way up here to 157 or so, that was a 27% gain from June to September, right? And, you know, for a lot of people, that's a huge, I mean, for any stock, that's a huge return in that's January, June, July, August, September. That's 3-4 months, right?
Yeah.
That's a huge gain, you know, on one individual stock in your portfolio. But then this is the funny thing about people and sometimes about clients is they're like, oh man, but Apple is down. It's down here to 147 now. And I'm like, well, bro, you bought it down. We bought it down here at 123. Like, you know, calm down. It's gonna be all right. You know, like we're up almost 20+% in 3 months on this one position. Like, let's just be patient, you know, give it some time. We invested this money for the long haul. All right. We got plenty of time for Apple to do its thing.
And you got to also tell people that most people roughly say the stock market is only going to give you 8% return in a year. So if you tell someone, listen, you just got 23% in 3 months, you're doing excellent. Like, let's not go overboard.
Right.
Let's keep the focus, because the average person probably going to get 8%. You got 23. So like,
yeah, and we're gonna talk about that a little bit, because I'm glad you brought up that point, because a lot of people kind of get that confused as to what the return on their portfolio is going to be. They get a false sense or false idea about.
You all right over there,
Man,
man?
my eyes, my eye here is killing me, bro. So I had to work on that. But I hope the people forgive me for that. But you know how it is, man.
Tell them,
But
listen, you're looking at them stocks, man. You seeing 23% on your position, you know.
had to check that thing twice. But so now what I want to do is I want to go into what I call the silent assassins. And the reason I call them assassins is because they assassinate the value of a dollar as well as the returns of your portfolio. And one of the things that we'll talk about is the more realistic expected return on the S&P 500 net of fees and taxes, because a lot of people like to talk about the gross return of the S&P 500, which is about 8% over a 30-year period of time. But do you really realize 8%? And are you somebody that can actually stomach that type of allocation when it comes to having 100% of your money invested in stocks? So what I'm going to do right quick is I don't want my client information to be.
So yeah, if you're listening out there, go ahead and name the silent assassins. If you can name both of them, we might be giving a giveaway at the end of the episode. So go ahead and check that out. Just want to put that out there.
And I'm just logging into my software here so I can give the folks a demo tonight about inflation and taxes and how deadly they can be. But while we're waiting on this to come up,
I was about to just say, just like the scenario I gave in the beginning of the podcast about my friend having 6 figures in the account and it's just sitting in the bank account or probably a shoebox, whatever is sitting in, that's his
not
business.
The shoebox. Might as well put it under the mattress, man.
You know what I'm saying? He's losing out on gains. Or not even, I won't even say he's losing out on gains. His money just depreciating over time. So
yeah, let's expand on that right quick, because it's a lot of people. I just had this conversation with an old timer in my office. He came to my door. He was like, I have this woman's money and it's, earning 3%. And I was like, well, I don't think that's too great, because I was like, she's more than likely she's losing money to inflation. And I think this is a simple example that I can give to people that will resonate with a lot of people. Now, I'll be 38, if I live to see next month, October 22nd, right? So if y'all
October babies.
Yeah, definitely. If y'all want to, send me some love on the 22nd of October, feel free to do so. But I can vividly remember, and maybe you can too, Bartu. I can vividly remember when regular gas was 89 cents a gallon, right? Now, some people might laugh at me because they're like, dang, you that old? I can't remember when gas was that cheap, but I can vividly remember pulling up to the gas tank and, taking the money in to pay for the gas for my mom to put gas in the car. It was 89 cents a gallon. Now, Bartu, quick question. If you pull up to the gas tank today, depending on where you are, roughly how much is one gallon of regular gas?
Probably like 340, 360, something around there. But
exactly. So I'm gonna break this down to the ridiculous. So what I did here was I just pulled up a future value calculator, right? This just says, hey, if we have $1 today and we put in a rate of say 3%, because historically, you can look this up on the on the Federal Reserve website if you want to, but typically the historical rate of inflation grows at about 3% per year. All right. So if we said, hey, if I have $1 today, this is what this calculation is going to tell us. If I had $1 today and I fast forward 30 years down the road with and I assumed an inflation rate of 3%, what will it take, or how many dollars will I need to have to equal this $1 or feel like I got $1 today or tomorrow, right? So basically $1 today is not going to be worth $1 30 years from today.
Oh, let me say this real quick. In the words of Fat Joe, today's prices isn't tomorrow's prices. So that dollar ain't worth the same tomorrow.
That's exactly the example. That's what we want to get over to people, that if you don't have your money working for you, then you leave it up to these silent assassins to silently kill the value of your money just by leaving it sitting in the bank. So let's just play this out right quick. I'm gonna come out here to 30 years, right? So in a small scale example, 30 years from today, you're going to need $2 in order to feel like to have the same amount of spending power that this $1 has today. Does that make sense?
Yeah.
So let me say that again. 30 years from today, if I gave you $1 today and then put you 30 years into the future, it's going to take $2 for you to have the same spending power that $1 has today. Meaning, if you went to the store today and could buy a Coke for $1, if we fast forward you 30 years from today and put you into 2051, you would need $2 to buy that same bottle of Coke. That makes sense?
Mm-hmm. Yeah.
So let's just magnify this, because a lot of people say, oh man, if I had $100,000 in retirement, I'll be good. And I'll say, oh really? I say, do you? Because really, in order for you to feel like you're spending $100,000, you're going to need $242,000 30 years from today. So I want people to understand, and even let's give them the benefit of the doubt and say that silent assassin isn't as worse as we think. Even at 2%, you're still going to need $81,000 more than what you need in today's dollars to have the same level of spending power. So this is inflation. And if you've been paying attention at all to anything economic related, right? We've seen that the federal government has had to take extraordinary measures to save the economy. And if you're not paying attention to this stuff and you're leaving your money sitting at the bank, or better yet, like your boy under the mattress, then you're gonna be in for a rude awakening when you think you're holding some money, when you think you're holding on to that $100,000 and you fast forward 10, 20, 30 years down the road and that $100,000 don't spend the same, or it doesn't have the same buying power that you have in today's dollar. So this is more important of why you need to have your money working for you. Maybe you don't put all of your cash in the stock market, but you need to have a good sum of it working for you. Because if your money isn't working for you, I think we were talking about this before the podcast this evening in the book, The Richest Man in Babylon. What does he say?
What part?
In the book, The Richest Man in Babylon, what are your dollars like?
Oh, they're like soldiers.
Right.
They got to go to work for you. You got to recruit more soldiers to build your army. Because
That's
if they
right.
don't, you're about to be at war by yourself.
Right. And the soldiers, as we relate this to money, the soldiers that they're recruiting is in the form of interest. So you need to have your soldiers earning interest year after year, month after month on those dollars that you invest in order to fight off inflation. So if your money is only growing at 3% or less, and inflation is growing at 3%. So let's just think about this right quick. Your money is growing at 3%. Inflation is growing at 3%. What is your real rate of return net of inflation? What is it?
You get no returns. You cancel out.
It's zero, right? So that's what people need to understand. And this is just fundamental stuff that we're not taught in high school. You know, we talk about inflation, but it's almost kind of like haphazardly, oh, that's inflation. Well, no, I don't think, especially in our community, I don't think it's explained to this level to help people understand that, look, you can't just, it's great that you're saving money. You know, I applaud that all day long, you know, and get a good pat on the back. But if your money is not working, you're doing yourself a disservice, and you're doing your money a disservice, more importantly.
Yeah. And just to go back to your scenario, that how you started off with the gas, you being able to get gas for under $1. Like, I remember like when $5 was like, you know, oh, I got $5 on the tank. And you kind of felt good about it. You're like, $5, that's like a quarter of a tank. We can ride someplace, like we can.
Oh no, half a tank.
I had a big car. I had an 84 Regal. So that $5 wasn't going too far. But it made you feel good. Like, we can go to the other school to go to the football games, whatever.
Right.
Now somebody come to you and be like, yo, I got $5 for the tank. You be like, yo, we not leaving the house. Like,
you be like, $5. I forget what movie that's from, but $5. But yeah, you know, there ain't much to talk about these days. You know, you need to be, that needs to be more like $20. You know what I'm saying? In order to, you know, have the same quarter tank of gas, you know, going into the Regal. You know what I mean?
Definitely.
So that's inflation, folks. You got to be aware of inflation, and you got to be aware of how it silently kills the value of your money if you're not paying attention, and if you're not getting some good advice on where to park some of your money.
And another quick point real fast is inflation is 3%, right?
Mm-hmm.
So even if my friend took his money out of the shoebox and took it to the bank, we might need to stop calling it the shoebox. We don't know who's listening. He have his money in his personal savings account. And as you know, the bank gives you an interest of 0.00002%.
Mm-hmm.
You know what I'm saying? So even if he did kept his money in the bank, the growth of the money that the bank would give you will be very low compared to inflation. Some of the other things that you probably could do if you didn't want to get into the stock market would be look for online banks, which actually doesn't have any brick and mortar buildings, but they're only online, and they give out a greater percentage on the interest of the money for being inside that bank.
Yeah, and to that point, it's great that you bring that up. But even still, like for online money market accounts, even the money market account that I used to encourage, you know, my clients to participate in, when the stock market fell and the bond market fell, like the return on bonds last year was negative. So a lot of people saw those online, those quote unquote high interest yielding savings accounts online. They saw those things either get cut in half or cut down darn near to zero because bonds were in the tank. And when interest rates were really low, those banks can't earn any money by the rates being so low. So therefore they cut into the returns that were once a good thing or once a nice, healthy thing. Now it's not so much.
Yeah, they would cut it continuously. Like they can cut it and then decide a day, 2 days, a month later, they'd be like, you know what? We got to cut it again. With not even, they just give you a notification that it has been cut. Like, so your interest rate could went from 3%, 2.5%, 1.5%. They might cut it down to 1% and be like, it's a possibility it can go up, but right now this is where it's at.
It's gonna be there for a while too. But now this is one exercise that I enjoy going through with clients here, and I really do hope people take this nugget away from this. So what we're doing here is I'm looking at a study period of the last 44 years, almost a mirror image of what we looked at from our first episode, right? So, and I said, okay, if we start from here in 1975 and go out 44 years, that'll bring us up to 2018, right? So let's bring it up as close as we can, say 46 years, bring us up to at least 2020, right? So we got 46 years of market data is what we're going to look at here. And what we're saying is this person is putting away $15,000 a year. And this happens to be somebody that has the stomach to that said, hey, I saw, the first Dispenses Written episode from you guys, and that I believe I'm that person that can just stay the course. I'm not going to waver. I don't care what's going to happen in the stock market. I know it's going to go up. I know it's going to go down, but I'm just going to stay the course and I'm going to stay patient. Now, let's be real for a second. How many people do you know that's like that, bar two, that says, hey, I'm going to just put it all on black and I'm just going to turn my back, Gilbert Arenas style, walk down to the other side of the court after I shoot the three?
It's very few. It's very few. But hopefully, after watching Dispenses Written on the first and third Wednesdays with Bar 2, co-host Terry Scipio, they can understand and learn that keeping the money in the stock market is actually a good win. But
yeah, it's a good thing. And maybe you don't want to be 100% in equities because that's a very unique person, right? Most people have their money spread around to different areas and they don't have it all in equities. So what I want people to, first thing I want people to take away from this exercise that we're getting ready to go through here is that when people talk about, or when you hear people say, oh, the market did 25% last year, or the market did 30% last year, what they're talking about is the return of the S&P 500. And therefore, if you don't have 100% of your money invested in the S&P 500, then you're not going to get that 25 or 30% or whatever the double-digit return was. Your return is going to be something less because more than likely you have an allocation that looks more like a 50-50 allocation, meaning you got 50% of your money in equities and 50% of your money in things that are what we call fixed assets or relatively safe type of allocations. So I just want to put this out here. So let's just go and look at what this looks like for somebody, if this person was just stayed the course and just put $15,000 a year away into this 100% equity allocation, right? So let's just see what this would look like. So at the end of the day, this person would have about $17 million in assets, right? If they put 15,000, if they had started in 19, what was this? That was 19. If they had started in 1975 and put $15,000 away in a 100% equity portfolio, this person would have had $17.5 million, right? Now, here's what a lot of people don't realize. So let's just go and look at, so the lifetime rate of return in a 100% allocation like this from 1975 all the way up to 2020, this is the return of the S&P 500 right here, right? So this is the return of the S&P 500 every single year going up. And you got 3 years of almost double-digit negative returns here from 2000 to 2002. But you can see here that there's only a handful of times that the market is down really heavy, right? But when it takes a crap, it takes a crap. You see that, and it hurts, right? But for the most part, the market typically is up, right? So if we look at this, we can say that, all right, if this person just stayed the course, that'd be great. But what if we take into account investment fees, right?
Hold on one second. Can you go back to that real quick?
Mm-hmm.
I want people to see something. Go all the way down to the bottom. All the way down. Over the course of time of the 45, 46 years, the individual actually only put in $690,000 to acquire 17 plus million.
Yep.
I just wanted to put that out there.
That's good. That's good that you caught that. So, and again, this is somebody that said, you know what, I'm just gonna stay the course. And so the return is 8%. I mean, 10.82% before we talk about any fees or any taxes. Now, We live in the United States of America. If you make money in any aspect of your life, who do you got to pay?
Uncle Sam getting this cut. You heard?
Uncle Sam gonna come get his. Whether you allow him in your pockets or not, he gonna find his way in there some way or another, right? And so we got to pay some taxes here, right? So what we assumed was somebody who's in a 25% tax bracket. And we said they were going to have a capital gains tax rate of 15%. But if you have your money invested, you're typically paying some type of fees, whether they're expense charges or you're paying a professional like myself, 1% to manage the assets for you. So let's just see after what is the return net of fees and any taxes, because these are the things that people fail to mention. They just tell you, oh, we're going to have 17 million. Well, let's look at what the investment fees do to the portfolio. Okay, so now with 17 million, before we talked about any investment fees, now we're down to 10 million, right? Now let's put in taxes on top of that. We only assuming a 15% capital gains tax rate, and we're assuming 25% ordinary income tax rate. We can talk about ordinary income tax and all that stuff in another discussion. But now we see the impact of fees and taxes. We went from 17 million here, not thinking about any fees and taxes, to now we're down here almost basically $5 million here, right? And I want to show you the details, go dive deeper. So net of fees and taxes, this is what's important. This is the huge takeaway, right? Net of fees and taxes for somebody who invested 100% of their money in stocks over a 30-year period of time. And this person had put $690,000 total in a portfolio. Net of fees and taxes, their return is going to be roughly 7%. See that? And this is what people
talked about earlier.
This is what people don't explain to folks when they talk about the return of the S&P 500. They just look at that 10.8% that we saw before, never taking into account investment fees and taxes. And these are real things that impact or silently kill the returns on your portfolio. And you need to have a financial plan that says, okay, if this is what my real rate of return or what I should really expect as my rate of return on my portfolio, I need to have a financial plan to help me weather this storm, because instead of that $17 million number we saw here before we accounted for fees and taxes, now we're looking at roughly $5 million. That changes a lot. That changes your outlook on things a lot. Now, let's play a game here. Let's see if we said, okay, because in our example, we assume 25% in taxes, right? Now, and we can play around with the investment fee too. So, because a lot of people say, oh, well, that's just, you manipulating the numbers. No, I'm not. So let's just look at all the numbers, right? Let's say you just had the best, the lowest fees you could possibly get, right? Let's say you got 50 basis points that you're paying rather than 100 basis points here. All right, at 25%, you got $6.5 million. Great. But as taxes, if you do as well as you anticipate doing, and your tax rates continue to increase, and like the Democrats have proposed, hiking up taxes, I'm not trying to make this a political thing, but if tax rates are at their all-time lows right now, and the government has had to stimulate the economy in such a drastic way by spending trillions of dollars and continuing to spend more money, what is one left to think about the future of where taxes could go? Just thinking from a pure probability standpoint here, where do you believe that taxes could go in the future, higher or lower?
Oh, taxes is definitely going to go up. If we at an all-time low, it has no other place to go but up.
And I just like to be a little bit more cautious because I'm a registered rep, right? I like to just say, from a probability standpoint, I believe that taxes could go higher in the future. And so if that's the case, then we're looking at, if let's just say the marginal tax rate, what they're talking about this now, that if you are in the top, if you're making over $400,000, you'll probably be in a 39.6% tax bracket. So even with the smallest investment fees that you can possibly muster, you still only accumulate $5 million in your portfolio in a 100% equity allocation. That's important. 100% equity allocation, and you're going to have $5 million. $5 million is $5 million. Now, let me change this. Let me show you how this drastically changes things if you're somebody that says you want to be more conservative. So instead of 100% equity allocation, meaning we're all in 100% in stocks, if you take an allocation that's less than that and say, I want to kind of play it, even keel 50-50, right? Now let's see what the details look like. And what's your rate of return net of fees and net of taxes? Now we're at 5.9%. See what I'm saying?
Yeah.
And if we look at the variances here, that looks a lot different.
A whole lot different.
Exactly. And this person has put 15 grand away for 45 years. Right. So this is why, I hate to say this, but it's important for me to say it. Like, I laugh when people say that they're going to do things on their own. Like, and I know you don't heard me say that before, but I really do laugh when people say, oh yeah, I'm going to just do this all on my own. I do this all day, every day. This is all I do. I'm not some part-time Joe, that does this. Like, I study this stuff. I know this stuff backwards and forwards. And so for somebody, it's just laughable to me. It's like, I'm not going to come into the pharmacy and say, yeah, man, I'm good. I don't need you to, give me any direction about my meds. Or, yeah, doc, yeah, doctor, Mr. Surgeon or Mrs. Surgeon, I'm good. I don't need you to cut on me. I'm gonna go home and, WebMD this thing, and I'll handle it myself. I'll scoop this cancer out by myself. It's like, come on, man. Let's let the professional be the professional.
Definitely. But it's funny though, people really do try to come up in the pharmacy and tell you how to do your job. You're like, yo, ma'am, sir, I need you to calm down.
Yeah. Trust me, I get the YouTube research that folks want to bring me to, and what they've heard on some other platform.
Yeah.
And I just laugh. I really do. I laugh, and and then I educate. But
I got a question for you, because what we're looking at seems something like for this person, seems like this would be an investment into their 401k, right? Or something like that, because a set amount for so many years could be that. Like the 401k now are more of retired date. What is it called?
Target
age.
date funds.
Say it again.
Target date
funds. Yes. Yeah. So what are you got the same views on that as this, because it's basically the same thing?
As target date. So by nature, target date funds are supposed to, let's say my retirement date is 2060, right? So by nature, the further away you are from that target date or that expiration date on the fund, the more aggressive that fund is going to be, right? And as you approach the end of that target date, it gets more conservative. Mm-hmm. So that's just the basics of how target date funds work. So I don't know if that answered your question about.
Yeah, now I'm just trying to see this scenario with this person seem like they could be in a 401k or a segment like that. And we did the 100% equity. I think at one time you probably could have tell your 401k to be all stocks. But now a lot of companies are going towards the target date fund, and they have a mix, like how you just saying. So the further out, more aggressive, closer you get, very conservative. So just in that speak, you went to a 50-50 blend. So let's just say that rounds out your 30 years in the target date fund.
Mm-hmm.
So if you would actually put in that 690,000, this is roughly what you will get at the end of your 30 years, 40 years of working in your retirement.
So this is interesting. I'm glad you asked that question. So let's just say you were somebody who, and these are the variables that, unfortunately, clients who try to manage their own portfolios, they don't take into account. So, I applaud people who do manage their own stuff, and some do a great job and some not so much. But let's say you were this person, right? And you had a 50 allocation, or you were in that target date fund and it got more conservative as you approach retirement, and you had projected to retire February of last year, right? Well, only for you to see, even if you had that safe allocation, everything was in the trash. Bonds were in the trash, and bonds are still in the trash. And we're a year, 18 months post-pandemic here, right? So for somebody, even if you didn't have a financial plan that would address having a hiccup like this 30 years down the road, because again, as great as the stock market is, and I love the stock market and what it can do for your money more than anybody else, right? But what you can't predict is when these mishaps are going to happen to your portfolio. So you got to have a plan that says, hey, regardless of what's happening in the stock market, I have a mechanism in place that will allow me to take advantage of this dip, because like we've seen in our history lesson on the S&P 500, we need to get greedy when we see the market down here, right? Yeah. So you need to have a financial plan that allows you, one, to still realize your goal and be able to walk out the door when you said you wanted to walk out the door, and better yet, take advantage of everything being on sale in the stock market, and you can ride this wave back up. Right. And if you don't have a financial plan that will allow you to make those kind of moves, then you paddling up creek with one oar. You know what I'm saying? You ain't got two oars, you got one.
Hey, you know any good place they can find out an advisor that can help them find this financial plan that you speak of?
I think so, man. First and third Wednesdays, Dispense is written, baby. Come and get it. But man, I think I've been on the soapbox, for a while here. But I hope people got the message. But this is just a sample of what I do and the value that I bring to my clients, just to help them open their eyes to variables and things that they may not have considered or may not see with their own eyes. But I can give them some education as to what are some of the things that they need to be thinking about. How can we plan for these unforeseen type of events to happen, and you can still realize your retirement goals as you anticipated, regardless of the hiccups that happen in the stock market.
Yeah. So as we rounded out this series, this was series 1, which was 3 parts. I want you to give them a quick recap of that, and then let them know what's the new series coming forward.
All right. So real quick, we talked about the history lesson on the stock market and why you want to stay invested over time, long-term in the market, whether it's in stocks or in a mix of stocks and bond allocation. And in session 2, we talked about what are ETFs and how can you simplify your trading or your investment approach. You can buy ETFs. That kind of takes the guesswork out of it. You still are encouraged to do your own research, but ETFs kind of give you a broader swatch of individual sectors or a particular index that you can invest in, and that will give you that diversification that you may be seeking for your investment allocation. And then in tonight, what we talked about was what were some of the fundamental aspects to look for when you are investing in stocks or attempting to invest in stocks. And then we also talk really quickly about the technical aspects. And when you marry the two together, the fundamental aspects as well as the technical aspects, I can give you a good indication about the health of that particular company, the health of that particular stock, and you can make an informed decision about whether or not you want to invest your money there. What to look forward to here on Dispense Written on the first and third Wednesdays coming forward. I haven't yet decided about where I want to take us, whether I want to go down the route of, debt management or more so into the protection or risk management arena. That's something I'll decide in the next couple of weeks. But those are just some of the things and some of the topics to look forward to. We welcome any type of comments or proposals from any of our listeners as well.
Yeah. So if anybody want to go back, listen to where my little book at? Because Terry was on Pill Talk podcast as one of the first guests.
Oh yeah, man, that was back in 2020. We talked about Boeing that day.
I probably should have bought some that day too.
Oh yeah. Boeing is still at a good price though.
So yeah, you was episode 7. So if anybody want to go back and look at episode 7 and see what Terry's journey is about the whole Scipio financial platform and what all he does for his clientele, and then go back and look at Dispense Written Wednesdays, our 3 episodes so far in our first series, called Introduction to the Stock Market, because it gives you everything you need to learn and know what is in the stock market. For our first series, that'd be dope if you guys can go back, check that out.
Check all 3 of them out.
Yeah, because I want people to know that they build on top of each other.
Yeah,
like
definitely.
You can catch this one and it's like watching a TV show starting in the middle of the season. You know what I mean? Yeah, you get the preview of what happened prior, but you're not getting the details. Right. We want to make sure that you guys go back and get the details and see what, definitely if you're a new investor, because a lot of people are coming to me like, yo, I want to get into the stock market. I want to know this. I want to know that. And I'm like, yo, we're giving you guys the game online right now. Like, you don't need me to say it in the Cliff Note forms. You can get your paper, your pad, come back, laugh at the jokes. They're hilarious too. I laugh at myself all the time. and take your notes for real though, and be able to be making smart decisions on yourself and not being someone to hold your hand throughout the whole process. So I just want to make sure we say that. And then going forward, since we just actually talked about the inflation and the 2 assassins, if anybody can put the 2 assassins in the chat right now, and I'll send you a free shirt. But you can pick the shirt, Pill Talk Podcast, the original logo. You could do Bigger Dreams, Less Worries. Or if you like empower leaders, because we out here trying to empower the people. But back to the scenario. Since we talked about the 2 silent assassins,
inflation and taxes.
Yeah, we got to make sure that let's talk about debt next, because a lot of people we talked
this
about
is the
how
holiday season.
Yeah, it's holiday season coming up, and listen, if anybody's spending like how they spend money this summer, holiday season about to be crazy, because everything was high this summer, like everything. So just imagine holiday season, the backlog. Like if you're about to order anything for the holiday season, go ahead and start ordering it now.
Oh yeah.
So that way you can be able to get it, package it up, and have it ready under the tree by December 25th. If not, you're not getting into next year, probably.
Yeah. UPS, FedEx has already said that a lot of stuff ain't gonna get there when it's already happening. Like supply chain is disrupted everywhere. So if your kid has been nagging you about that Xbox or whatever, You might want to go ahead and order that bad boy now. Otherwise, it probably ain't gonna get there in time.
Put that box next to that shoe box full of money under the bed.
I got the shoe box, man.
But yeah.
But definitely, folks. If I can ever help anybody out there that's listening, come here to this landing page. Go to pilltalk.podcast. Let me just put it in here so I can. It's pilltalk.terryscipio.com, and that'll bring you to this page here, where it has this, beautiful little young lady here, which is my daughter. Forget this little fellow over here, but you can connect with me. Send me an email. Let's talk. You can reach me on my website as well, scipiofinancial.com. Come here, get some good information. Talking about personal planning, talk about medical professionals, which is one of the main demographics that I serve. So if you're a medical professional out there looking for a good financial advisor, I'm your guy. Give me a call. You can reach me at 843, move this around, 843-765-2010, terryscipio@cplanning.com. That's the email. Find us on Facebook, LinkedIn, etc.
That's what's up. Also, man, I want people to know Pill Talk Podcast has been out for 1 year already.
That's big time, man. Congratulations.
Appreciate it. The grind has been something else, man. The grind has been something else. Being able to start from having a vision, having a dream, and able to actually reach out and start talking to the people, start communicating with everyone, start building my network and growing. I started by myself, was able to get to an editor, and then was able to now have a marketing team behind me who's about to push this to the next level. So I want to say thanks to everyone that started with me on day one. Thanks for everyone that joined in during the journey. And I appreciate everyone for all their love and support. And also, if you would like Pill Talk to be one of your brand ambassadors, because obviously we're not going anywhere. It's only going up from here. That's right. You want to get your product, your course, your business in front of a bigger crowd, you can come on here, email me directly, message me directly, just get in contact with me. I will make sure that we promote your brand in the best light ever and have you out there getting more clientele, because obviously we are in 15 different countries as we speak.
Nice.
Thousands of engagements every day. I have growing listeners every day. So if you want us to be your brand ambassador and get your product out there, hit me up. I send you the packet so we can get you out there and get you known and seen in 15 different plus countries. So
nice.
And the whole family on the screen now.
Yeah, last thing, people, listen up closely. I got these 4 little ones. They all need to go to school, get an education. We need your support here on Pill Talk Podcast. But yeah, man, these are my little ones. These are my twins here. This is my 6-year-old. This is my 8-year-old now. This is an old picture, but this is one of my favorite pictures of them.
That's what's up. Love it. I love it.
All right, man. I think we had a good session tonight, man. I think we dropped some jewels as usual. And I hope the people appreciate it and see it for what it's worth as well.
Yes, sir. Yes, sir. So you got to transfer the screen back.
For sure. Let me give it back.
All right. So this was another episode of Dispense Written Wednesdays with my co-host Terry Scipio. On the first and third Wednesdays, we talk about personal finance. We want to make sure that you guys are making the right decisions and doing your education to educate yourself more financially. So make sure you check out Scipio Financial, check out Pill Talk Podcast. Make sure you get the merch from both of us and be on the lookout because we're delivering more and more information. We're going to give you guys bigger and better productions as we grow. So be on the lookout for us growing as the network grow. So appreciate you guys. Thank you for coming to Pill Talk Podcast and Dispense is Written. Thank you.
Thanks, folks.